Welcome to the Poundcast, the Digital Pound Foundation's podcast dedicated to explaining and discussing all aspects of a digital pound and the impacts of new forms of digital money more broadly. Your host today is Jannah Patchay, Policy Lead and one of the originating members of the Digital Pound Foundation. Today, Jannah will be in conversation with Tony McLaughlin, Managing Director of Emerging Payments and Business Development at Citibank. In this episode, Jannah and Tony have a wide-ranging discussion on what would make a digital pound a foundation for innovation, and what attributes should it have? How do concepts like fungibility and interoperability support an ecosystem of digital pounds? Regulated liabilities, what are they? And what are different types of money? They also look at Tony's thoughts on stablecoins and the latest industry developments around them.
I'm Jannah Patchay, Policy Lead for the Digital Pound Foundation, and today I'm joined by Tony McLaughlin, Managing Director of Emerging Payments and Business Development at Citibank. Welcome, Tony. It's great to have you here with us today.
Hi, Jannah. It's a pleasure.
Let's start off by telling us a little bit about yourself and your role at Citibank and what's brought you to the space, digital currencies.
Sure, Jannah. I've been working in the payment space for going on 30 years and very interested in new methods of payment, open banking, instant payments, etc. And I have to say that for the first 25 years of my career, payments wasn't a very sexy subject for the rest of the world, but maybe thanks to crypto and some of the latest developments, it's become a really hot topic. My journey on digital assets and cryptocurrencies, CBDC, really started, as I think with most people, with a close interest in Libra and watching the consequences of that proposal play out has been fascinating.
I agree. I would say that's actually one of the things that brought me into this space as well, trying to dissect the regulatory structure of Libra as it was then proposed. But today we're here to talk about your thoughts on a digital pound and your thoughts as well on how that might work in practice and interoperate with different forms of money that we have today in the UK. But let's start at the beginning. What does it actually mean to have a digital pound? Because the money we use today, that's pretty much digitally represented anyway, isn't it? I don't really use cash anymore. And every time I transact, it's using my phone, or occasionally I might have to get out a card, but it's all account to account and it's all electronic behind the scenes. So what's the distinction between that digital money and this concept of a digital pound?
That's a great question, Jannah. You're quite right that the money that most people transact in today is indeed digital, but it's digital in a specific way. So a bank balance at Barclays is living on a relational database in Barclays data center, and a bank balance at HSBC is an entry on a relational database in an HSBC data center, and so on and so forth. So the pattern of digital payments that we have today is one where you have these separate islands of data in each regulated institution. And payments essentially are conducted through messaging between these institutions through systems like the instant payment schemes, the faster payment schemes, or SWIFT or Visa or MasterCard. Essentially, these schemes that sit between the banks are messaging systems. And it's quite interesting, maybe not particularly well appreciated, that no matter how deeply you look into those systems, there's no money in those networks. The money is in the databases. The money is in the institutions at the edges of the network. So if you contrast that with a novel scheme like a Bitcoin or an Ethereum scheme, there's something which is topologically different in terms of the shape of the network. Because in Bitcoin or in Ethereum, the money or the value is represented in the network. So I think what's really happening when people talk about a digital pound is it's the application of that kind of shared ledger technology where the money would be represented in the network. And that kind of a network might have attributes that we would find difficult to emulate within the current paradigm, which is based upon every institution having their own database.
So right now, basically, if I transfer money from my bank account to yours at a different bank, then all that's actually happening at that level of where I think I'm transferring money is a message is going across saying debit this balance and credit this balance. Whereas actually the settlement between the two banks, even though something might show up in your account today and it will look like it's leaving my bank account, the actual settlement is happening elsewhere at the central bank and not necessarily synchronously. What you're saying is with these new forms of digital money, the value will actually be transferred across the network as at this instantaneously. Is that a good way of thinking about it?
Well, that's the attribute in the Bitcoin network, for example, because Bitcoin is not in the form of a liability. So the money that we transact with today, the Barclays balance, the HSBC balance, these are, from the bank's perspective, they are liabilities in favor of a particular customer. So Jannah, your HSBC account is actually, it has a balance sheet reality for HSBC. They owe you the money back. And a payment is actually the transfer of a liability between one institution and another institution. So if you're making me a payment, then what's really happening is that HSBC's liability to you is going down by £100, and Citibank's liability to me is going up by £100. So essentially what's happening in a payment today is HSBC is sending a message to Citibank, and it's saying, please increase your liabilities to Tony by £100. And then effectively what Citibank is saying from a balance sheet perspective is, okay, I'm happy to do that. I'm happy to increase my liabilities by £100 if I receive a matching asset, because the balance sheets have to remain level. So the matching asset that is transferred between HSBC and Citibank is central bank money. And Citibank and HSBC both have accounts at the Bank of England. And through the CHAP system, the real-time gross settlement system, what's really happening is that a matching asset is being moved from HSBC's account with the Bank of England to Citibank's account with the Bank of England. So a payment in the existing paradigm is a liability shift between two institutions, between HSBC and Citibank in this particular case. That liability shift is backed up by an asset shift, which is a transfer of central bank liabilities in the high value clearing system. Now, that paradigm doesn't exist in the world of Bitcoin, because Bitcoin isn't a liability of anyone. Bitcoin isn't a promise to pay the customer on demand at par value in national currency units, like HSBC promises to pay you back at par value in national currency units on demand. So in the Bitcoin paradigm, you've got this thing that acts as a bearer instrument that has apparent value in and of itself, which
So
makes
an asset?
well, to the extent that you believe it has value, it's more of a commodity form of money. And if you're willing to accept that commodity form of money in to extinguish some debt that I have to you, then you accept that as a form of money. But there's a fundamental difference between the existing money that people have in their bank accounts, which is a liability of a regulated institution, and Bitcoin, which isn't a liability of anyone. So really the question is there some sort of synthesis between the Bitcoin Ethereum way of transferring value and the liability shifts, which are the dominant feature of existing payment systems?
So how does this paradigm translate to new forms of digital money, such as stablecoins and CBDCs? And how does this shift to this new paradigm impact them? Is it in the same way or is it differently?
Yeah, let's go back in time a little bit to before Libra. Central bankers were not that concerned about the risk of Bitcoin taking off as a method of payment. and there were many papers that said that Bitcoin didn't meet the functions of money, the unit of account, medium of exchange, and store of value, because of the inherent volatility, because there's no backing behind the Bitcoin. Remember that Bitcoin was designed as a medium of exchange. It wasn't meant to be this speculative instrument that it is today. It was trying to be a payment system. And so it essentially didn't make it as a payment system. But then came along the stablecoin concept, which is that project is about saying, let's achieve a medium of exchange by stabilizing these crypto tokens and somehow get the best of both worlds, get the benefits of the new blockchain technology, but have the stability of existing fiat currency units, of the unit of account of nation states. So I think stablecoins are an attempt to bridge those two different worlds, but we're not across that bridge yet, because if you are a holder of a stablecoin, the stablecoins that exist today do not fulfill or have the same characteristics as your bank account. And there are some important differences there that we can go into if you'd like.
Please do.
First of all, when you have a bank account, you have a contract with a regulated legal entity. And that contract basically says that if you give your money to that entity, they've got to give it back to you. And there's a number of protections in place created by the nation state. The banks are regulated and have to keep capital, and there's the deposit insurance in case things go really wrong. All of these things are designed to make it unlikely that you don't get your money back.
And to maintain confidence in your national currency, right?
Exactly. If you are holding a stable coin, the issuer is not necessarily regulated by the nation state. You don't have a contract with the issuer. The issuer is not compelled to hold capital. The balances that you have in the stablecoin are not protected by any deposit insurance. And so there's a very significant gap between the consumer protections that exist with not just a bank account. I don't want to come across as being protective of the banking system, because you have very similar protections, or at least a framework of protections, if you're also dealing with a regulated non-bank, a fintech provider or someone who's operating under the e-money directive. The e-money directive is created a form of digital money with protections built in. You have a contract with the issuer has to pay you back, the issuer has to hold capital, the issuer has to hold the client monies separate from their own monies, etc., etc. So stablecoins are not quite at that same stage where you have the same kind of protections that you have if you're holding your money with a bank or a regulated non-bank fintech.
So basically today, when I'm making a payment, when I'm holding money in my bank account, when I'm using that money in any way, or even when somewhere behind the scenes it's being converted to e-money and moved across the network, I have confidence that I'm protected through all of this. I have confidence that a pound is a pound in whatever form I'm using it, and that a pound I hold as a £1 coin, however rarely that might be, has the same value as a pound that's in my bank account. And I guess there's this implicit expectation that many users have that the stable coins that they're using also holds that same level of confidence, but they don't really necessarily do they, both in the way that they're backed, but also importantly in the recourse that the user has in the event that something happens to that issuer.
Well, when you buy a stable coin on an exchange, you don't have a contract with the issuer. And also, very importantly, the issuer doesn't know who you are. And this is a fundamental difference between an account at a bank or an account at a fintech. The bank and the fintech know who you are. And the reason why they know who you are, Jannah, is because they owe you the money back. They have a contractual obligation to pay you the money back.
Which is good for me.
Which also makes these things cash equivalents. because you have a claim, you have an unambiguous legal claim on the issuer, and that issuer is regulated within your jurisdiction. And so you have recourse. So if your bank doesn't give you the money back, if your e-money company, if your fintech doesn't give you the money back, you have recourse within your jurisdiction against an entity licensed in that jurisdiction. And that's not the case with stablecoins at the moment. Now, I would anticipate that over time, when stablecoin regimes come into place, when stablecoins are brought within the regulatory perimeter, the same kind of protections that you have with a bank account or a fintech will apply to stablecoin. And in fact, I have a long-term viewpoint, which is a stablecoin is nothing more than e-money on a blockchain. And I can't think of any distinction. I can't think of any protection that you have with your PayPal account that you shouldn't have with your stablecoin. And I can't think of any obligation that PayPal has as a regulated entity that a stablecoin issuer shouldn't have as a regulated entity. And one of the most critical of those is the issuers need to know their customers.
That's a really interesting point that you've made, Tony, and I think goes to the heart of a lot of what we've been discussing at the Digital Pound Foundation lately, which is there's a lot of talk about stable coins, but actually what are stable coins? And if we're seeing regulatory frameworks emerging that require stable coins to be wholly backed by reserves held at a commercial bank, for example, then what is the difference between that and e-money as we have it today, except that one is token, but there shouldn't necessarily be a complete separation in a completely new regulatory regime around that, because this is about what the instrument is. On the other hand, that those stablecoins can have many different structures, and the question is then the nature of that structure. So are they algorithmic? Are they backed by multiple fiat currencies? Are they backed by a basket of other short-term assets, and what type of assets and things like that? And also their usage. Are they primarily used as a store of value? Are they primarily used as a means of payment? Are they intended to be used as a combination? And I think there's at the moment in both the UK and the EU this really narrow focus on this one type of stable coin that is basically tokenized e-money, to the exclusion of the other structures that can be taken, and even to the exclusion of considering what tokenized commercial bank money might look like and how it fits into this ecosystem in the future. What are your thoughts on that?
So I think you hit the nail on the head when you suggested that legal instruments are independent of technology. Distributed ledger technology, a blockchain is just a database. And so why should a change in database lead to a different legal analysis? I have a joke I make about this, which is when laser copiers were invented, they made counterfeiting easier. They didn't make it legal. And in a similar way, distributed ledger is a kind of digital printing press. Now, with that digital printing press, you might decide to set up your own central bank. You might decide to issue your own securities. You might decide to issue your own monetary instruments. It doesn't make it legal just because it's technologically possible. And so I think what we've seen is actually a remarkable degree of forbearance by the regulators, where they have allowed this gap to appear between what's possible technologically and what's possible legally, because there's been a genuine reluctance to stifle innovation. But that gap can only be allowed to grow so much. And I think we're at the stage where there's a realization that the medium of exchange needs to be tightly regulated. And stablecoins, I think you can imagine different constructions of stablecoins, but what we've got today in law is e-money. E-money is a kind of virtual money offered by a regulated non-bank. And if you think about it globally, e-money has been incredibly successful. I mean, there are hundreds of millions of customers around the world. There's PayPal and hundreds of millions of people using Paytm in India, and almost 1 billion people using Alipay and WeChat Pay in China, etc., 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 M-Pesa in Kenya. E-money has been a massive success all around the world to promote innovation and financial inclusion. So that's the framework that we have already. Why not apply that as a first step? Now, if in the future there's a case to be made for having a new type of legal instrument recognized in law, let's have the debate about what that should look like. For the time being, let's also, because of recent events, recognize that many consumers around the world have been harmed by the downfall of some of these novel forms of money.
And you touched there on the role of e-money, of digital money as a platform for innovation. So let's go down that rabbit hole a bit. What can we do with a digital pound, with digital native forms of money that we can't do today? And how can they help the transition or support the transition to a more fully digital economy?
Yeah, great question. And I think this gets to the heart of the project, which is testing out what I call the tokenization thesis. So there's this idea that in the future, all financial instruments will live on blockchains and be tokenized, and that would create this platform for innovation. Now let's just give a first pass at that tokenization thesis from a positive perspective. I like to compare the attributes of Ethereum with the traditional financial system and what are the differences. And I can point to three things that I like about the blockchain model, the Ethereum type model. Number one is Ethereum is always on, always running. The traditional financial system is not. The places where the financial system is always running are the exceptions that prove the rule. The stock markets, the equity markets, the FX markets, the debt markets, money markets do not run 24/7. So that's a difference. Now, could we make the traditional financial system run 24/7 with traditional technology? Sure, we could. But it's a fact that today the financial system is not always on, but Ethereum is. So this is one interesting characteristic. Second interesting characteristic is referring back to what I was saying before about the movement of money in today's world is through messaging, whereas in Ethereum, the assets are in a shared ledger. They're on chain. Now, so what? Well, Ethereum as a shared ledger is programmable. And I don't think there's anything, people talk about programmability as if it's a unique feature of a blockchain, and that's clearly nonsense. Programmability is something that Vitalik Buterin added to blockchains because it didn't exist within Bitcoin. And it just means that the network is Turing complete, meaning you can run any kind of calculation or run any scripts on the network. But it is kind of interesting if you've got a network which contains the money, which contains the digital assets, and then that network is Turing complete, maybe that opens up a new innovation space. Because at the moment, if you think back to the description of the traditional financial system, the HSBC money is in the HSBC data center on the HSBC relational database, and the Citibank money is in the Citibank data center in the Citibank relational database, et cetera, times 20,000 institutions. That system is not programmable in the same way. And then finally, an interesting aspect of Ethereum or attribute of Ethereum is that it is multi-asset. So on Ethereum, you have ETH, and you have a multiplicity of stable coins, and you have CryptoKitties, and you have NFTs, and you have whatever. You can express arbitrary types of digital assets in Ethereum. And what that means is that Ethereum is non-siloed. And in the banking system, it's famous for its silos. And what is a silo? A silo is a special purpose infrastructure for one kind of legal instrument. So we've got a high value clearing system and a low value clearing system, and we've got a different system for securities and a different system for XY, for the FX markets, X, Y, and Z. All of these.
Which is why when we settle, for example, securities trade, we've got actually one leg settling through payments infrastructure and the other leg settling through the securities infrastructure, and they could have latency between them, which creates counterparty exposure risk and settlement risk and things like that, right?
Just so. The tokenization hypothesis might be if we can have a structure that generalizes the representation of different digital assets and an infrastructure which can within itself contain different kinds of digital assets, that might open up a new innovation space. So these are three interesting global differences between Ethereum and the traditional financial system. Ethereum is always on. It's got that on-chain representation of the assets in a programmable network, and it is non-siloed, it's multi-asset. And so I think that's a hypothesis worth examining. But the next question is, if you have this always-on programmable multi-asset infrastructure, what kind of instruments should you put on it? And my answer is regulated instruments, that the financial instruments that go into that substrate should be issued by entities that are properly regulated. And I don't only mean banks, I mean regulated banks and regulated non-banks. So I'm trying to get to this conclusion, which is when you look at projects like CBDC, which is a single instrument, it's essentially using blockchain to replicate an existing form or to replicate something that we already have. Like in RTGS system, for example, we already have the ability to move around central bank money. Does it really give you a delta to put an RTGS system onto a blockchain? When in actual fact, maybe the secret sauce of the blockchain, maybe the difference is not the 24/7 aspect, yes, but the multi-asset nature of blockchain. So I think that the tokenization thesis is interesting to explore. I don't think it's proven. I don't think it's a given that in the future, every financial instrument will be on shared ledger technology. But I do find it intriguing to explore a different kind of architecture, which is less siloed and programmable and always on.
So I want to come back to this concept of regulated liabilities and the regulated liabilities network that you've proposed and I've read a little bit about on the Citi website. But first, just going back to this, the role of blockchain, the blockchain in all of this. And I can understand the importance of blockchain in enabling us to create digital native assets that are wholly transferable in value, and also due to the immutable nature of the blockchain can't just be copied. So they are both unique and immutable, and they can be wholly transferred from one owner to another. But also, we've seen in many jurisdictions that there are CBDC experiments and pilots, and even in the case of China with the ECNY at the moment, those do not necessarily involve blockchain. Therefore, is blockchain a prerequisite for a CBDC? I think it is for a stablecoin, just because by definition, a stablecoin is a token. But to the extent that CBDC can be implemented in different ways, are there advantages or disadvantages of implementing it on existing technologies, non-blockchain technology?
Yeah, again, going back in time, CBDC, this whole discussion about CBDC really was catalyzed by Libra. Libra was different from Bitcoin because for the first time, we could see the potential for a non-state actor creating an instrument that may potentially compete with sovereign currencies. And the natural reaction, the correct reaction from the sovereigns is to say, well, the sovereign currencies are a very important instrument of national self-determination, and we must protect the sovereign currencies. And therefore, if there's going to be this new form factor of money out there, which is the stablecoin, we should essentially look to create a new form factor for national currency, therefore CBDC. So it was certainly stimulated by a project that was built on blockchain. But you're perfectly right. Some countries have and can deploy CBDC on non-blockchain technology. And what is a CBDC? CBDC is basically an e-money account offered by the government. And it could be run on a blockchain or it could be run on a traditional database. But essentially, it's like the government offering an e-money account backed up by, not by reserves at a central bank, but backed up by the full faith and credit of the nation state. And so the question really is for CBDC is, should the government offer an e-money wallet? And can the government offer an e-money wallet? Because some people, I think, fall into the mistake of thinking that CBDC is digital cash or somehow a substitute for cash, when in fact, CBDC will enter the market of digital accounts offered by banks and regulated non-banks. So I think people are making a bit of a category error thinking of CBDC as a cash substitute. And if you'll indulge me for a second, I'll give you an analogy to try to illustrate that.
Go ahead.
So think about the difference between physical letters and email. So at the moment, you, like me, I'm sure you send physical letters from time to time. You send a lot more emails. Now, imagine the case where the government offered an email service, right? So the government offers an email service. Would that government email service be a substitute for physical letters, or would it be a substitute for your Gmail account? And so I think that parallel can be transferred across to this idea of CBDC. You get my point?
I do, yes.
Is a government digital wallet a substitute for physical cash or a substitute for your PayPal account?
Yes, and that's a really interesting analogy because it makes me think as well. Obviously, I can do most things I want to do with my Gmail account. So why would I want another email account? Unless there were things that I could do with it that I can't do with my Gmail account, unless, for example, I knew that it had higher standards of privacy, or it was better at holding my emails for longer and there was a guarantee that they'd never be deleted or something like that, or I could store my digital documents on there in perpetuity or something, then I would see a utility for it. And I can, obviously, all of those have direct parallels to why the public would actually make use of the CBDC. So that's a really good analogy, I think. Yeah.
So that then comes to the point of CBDC needs to occupy a kind of Goldilocks zone where it's not too big and it's not too small. And there are lots of people who think that, or lots of articles and literature which plays out the scenario of it being too big and then being a substitute for the private sector, the private financial sector. In the same way, imagining that a government email service would take over, like from Outlook and Gmail, which I think is a fairly ridiculous proposal. And that leads me to think that there should be equal attention paid to the prospect of it being too small, because CBDC has almost been like a kind of Rorschach test. Like everyone looks at it and they see different things and they project upon it different policy objectives. But one thing which is true is that those policy objectives are only going to be achieved if a relatively large proportion of the population actually uses the CBDC. So I think it's worth considering that CBDC could land on either side of the Goldilocks zone. It could be too big or it could be too small.
I think there's probably a lot more we could say on that particular topic, but I'm conscious of time. And there's also another question that I really want to ask you, because we've now touched on all of these different forms of digital money. We've talked about tokenized commercial bank money a little bit. We've talked about tokenized e-money. We've talked about this concept of stablecoins, as well as the different forms that CBDCs can take. And in the future, we're quite likely to see, whatever they're called or however they're branded in the future, that there will be different forms of digital money that are available out there. And the key thing throughout this is that, if we've got different forms, both privately and publicly issued digital pounds in the UK, that we remain faithful to this principle that a pound is a pound. If I'm transacting using my stable coin of the future, or Amazon coin, or whatever you want, whatever it will be, it has a pound in that has the same value as any other pound, as a pound in cash or anything else. Even though there might be different incentives for me to use them, in the same way that there's different incentives for me to hold my money in different bank accounts due to different interest rates and things like that. This proliferation of potentially different types of digital pounds has the potential to just lead to walled gardens, silos, horrible closed ecosystems that reduce competition and increase costs and reduce opportunities and freedom of choice for users as well. You've mentioned this idea of this regulated liabilities network. How might that support a diverse and effective ecosystem of these different types of digital money in the future?
Yeah, so that the Regulated Liability Network project is just a suggestion to say, let's have a digital pound. But why on earth should the digital pound be limited to central bank money? Because for most economic actors, I mean, your pounds are HSBC pounds, my pounds are NatWest pounds, somebody else's pounds are Lloyds Bank pounds. And for someone else, they are PayPal pounds. So the sovereign currency system is made up of central bank money, commercial bank money, and e-money issued by regulated non-banks. And in the future, it might be made up of money issued by well-regulated stablecoin issuers. So the regulated liability network concept is simply a suggestion that let's have a digital pound made up of those 3 or 4 different faces of the pound that we know today. And let's explore the on-chain paradigm. Let's explore that tokenization thesis that if we had a new substrate for pounds, where that substrate was always on, programmable, and I think critically multi-asset, that might create a new innovation space. So that's the concept that we've been exploring around the world with central banks and other regulated entities, because there is something interesting about these blockchains, but we've got to separate the wheat from the chaff. If I can just do that slightly, thinking of Bitcoin. So Bitcoin as a unit of account, if you believe that the nation state has the right to have a monopoly over money, then you don't like Bitcoin as a unit of account or a medium of exchange. Bitcoin as a non-liability, as a commodity form of money. If you believe that the medium of exchange should be the liability of an institution, this is a kind of deeper point. The type of money that we use, your HSBC balance, is one side of HSBC's balance sheet, and the other side of their balance sheet are the risk assets. And the risk assets build the world and power the economy. So the fact that the thing that you call money, your medium of exchange, is the fuel for risk assets, is extraordinarily important to our economic model. And if we moved to commodity money, then we'd be taking a significant step backwards, in my view. The other thing about Bitcoin as a bearer instrument, is it a good idea to have digital bearer instruments? Now, we have to be very, very concerned about financial crime, terrorist financing, money laundering, child trafficking, and all of these things that can be done with bearer instruments. We've been trying to get rid of bearer instruments from the financial system for decades. Do we really want to introduce bearer instruments back into the modern digital economy? I'm not so sure.
And from what you said earlier, the stablecoins in the form that we have them right now are pretty much bearer instruments, aren't they?
They are bearer instruments. And the reality is that the issuers of those instruments do not know the holders of those instruments. And that to me appears problematic, to say the least. So if we peel back the things that are not interesting from a kind of regulated and sovereign point of view, we're not interested in Bitcoin as a unit of account, we're not interested in non-liability money, we're not interested in bearer instruments. What we're left with is still very meaningful. It's an always-on multi-asset substrate ledger, shared ledger, that potentially opens up a new design space. And what should be on that ledger, to my mind, are regulated instruments. And that's what I call the regulated internet of value, is using that on-chain paradigm with existing legal instruments. And the thought process is as follows. In the 19th century, all legal instruments were recorded on paper ledgers. You can see them. You can walk into any bank, to their museum, to the Bank of England. You can see these paper ledgers. 19th century, all legal instruments recorded on paper ledgers. In the 20th century, all legal instruments migrated to relational databases held within the data centers run by each institution. In the 21st century, we might move towards using shared ledgers. Now, what does that mean? It's a little bit kind of parallel to using cloud, public cloud, AWS or Google Cloud or Azure. What's really happening there is that an entity like a bank is moving from having its own data center to having a shared data center. And a blockchain is the level above that. It's moving from having your own record-keeping database to using a shared record-keeping database. Now, my argument is Whether you're recording your instruments on a paper ledger in the 19th century, or a relational database in the 20th century, or on a blockchain in the 21st century, all that's changed is the technology to represent those instruments, not their legal substance. And so I think a very important point to make sense of this new space is we must keep legal instruments independent from the technology used to represent them. And just because you can do something with technology, just because with blockchain, I can set up the first bank of Tony and I can issue instruments that I claim are equivalent to pounds. I mean, if I started to print fake pounds on my photocopier, I'd be, a counterfeiter. If I start to print fake pounds on a digital printing press outside the law, not that different. So let's keep in mind that the legal code and the computer code have to ultimately be in sync. Of course, we can allow the technology to guide where the legal code follows, but the legal code needs to rapidly follow where the computer code is taking us. And that's basically the philosophy behind this idea of regulated liability network. We can't adopt this new substrate with existing legal instruments. And so when it comes to CBDC and digital pound, it just calls for a slight broadening of the conception. If we're going to adopt this new substrate, why would the only thing that we put on it be central bank money?
That's really interesting, Tony. And I think it raises even more questions that I'd love to explore, perhaps on another occasion, though. It's been absolutely fascinating having this conversation with you today. And thanks so much for joining us. And I think we'd absolutely love to hear more from you as your thinking develops in the future.
It's a great pleasure. Thank you very much for having me.
Thanks to all our listeners for joining us. You've been listening to the Poundcast, brought to you by the Digital Pound Foundation and hosted by Jannah Patchay. Subscribe to the podcast to stay informed of all our future shows, or sign up for our newsletter to get all the latest updates at digitalpoundfoundation.com. See you next time for more news about a digital pound.